Financial market news in 2024 and 2025 has been defined by volatility, shifting investor sentiment, and the interplay of central bank policies, geopolitical uncertainties, and corporate earnings, a balancing act between inflation control and economic growth. Here are the key updates and market insights you need. 1. Inflation pressures remain a key focus. Markets react swiftly to every new data point on consumer prices. 2. Concerns about slowing consumer demand. 3. Supply chain disruptions and commodity volatility. 4. Central bank policy. Uncertainty drives sentiment. 5. Political risks and energy prices add friction. Each of these pain points shapes trading across assets. Equities saw cycles of optimism and caution. Technology firms driving gains early in 2024. Late 2024 saw corrections as demand concerns returned. Europe had rallies, but energy and politics mattered. Asia presented a mixed picture, Japan helped by a weak yen. China struggled with property stress and slower consumption. Bond markets became a focus as yields rose. Yields hit multi-year highs in 2024 in many economies. In the United States, the 10-year yield frequently hovered near 4.5%. European yields climbed, pushing wider spreads in some countries. Currencies drew attention. The US dollar was strong. Developing economies faced higher import costs and debt pressure. Currency volatility affects trade and earnings for multinationals. Commodities, especially oil, swung on geopolitics and demand. Gold rose during risk-off periods, signaling risk aversion. Agricultural commodities flickered due to climate and supply issues. Banking sector stress and liquidity stories remained important. While systemic crises were avoided, vulnerabilities lingered. The global market environment became highly interconnected. Data dive, we tracked consumer prices, frequent surprises to the upside. GDP readings caused swings in expectations for policy. Labor markets kept markets guessing on rate paths. Tech sectors led early gains, driven by AI and semiconductors. Markets responded to earnings surprises with sharp moves. Bond yields hit multi-year highs before falling in mid-2025. The yield curve shifted as markets repriced recession risk. The dollar appreciated, pressuring emerging currencies. Earnings season showed tech outperformance and mixed results elsewhere. Oil swung widely in 2024, affecting inflation expectations. Gold spiked above $2,200 per ounce during volatility. Agricultural prices moved with weather and supply chain hits. Central bank statements and guidance drove market sentiment. Markets trades not just on decisions but on the language used. Volatility spikes correlated with surprise data and geopolitical flares. Investors rotated between sectors as risks updated. Credit conditions tightened in some linked banks. Some regional banks felt pressure from commercial real estate losses. Liquidity stories drew attention, but systemic failures were avoided. Cross-asset correlations shifted quickly. Watch for ripple effects. Each data release changed the direction of markets. Emerging markets faced pressure from a strong dollar. In 2025, many companies shifted focus to cost-cutting and guidance conservatism. Earnings surprises caused intraday volatility. Policy divergence between regions determined capital flows. Widening spreads in some European economies raised fiscal concerns. Investor psychology swung with every release. Global markets are highly interconnected. Events ripple fast. Risk-on and risk-off phases determined asset allocation shifts. Currency dynamics affected corporate earnings for multinationals. Use dashboards to track CPI, GDP, labor, and policy signals. Sector return patterns shift as fundamentals change. Short-term rates reflect liquidity and policy stance. Credit spreads tell a different story than government yields. High volume with spiking volatility signals rapid sentiment shifts. Tech earnings driving index leadership in early 2024. By 2025, corporate focus shifted to cost-cutting and cautious guidance. Banking news included liquidity pressures and restructuring news. Events in one region quickly affect global market sentiment. Investor psychology became a key channel for market moves. Risk management and hedging gained prominence. Portfolio allocations adjusted to rising rates and volatility. Capital flows shifted toward safer assets at times. Markets watched credit quality and default risks. Scenario modeling helped investors plan for multiple outcomes. Geopolitical tensions pushed oil prices up again in 2025. Gold remained a contingent safe haven during drawdowns. The timeline shows optimism, corrections, then partial easing. Day-to-day trading reflected rapid news sensitivity. Markets mined policy language for hints on easing timing. Sentiment swings translated quickly into price moves. Capital flow dynamics responded to rate differentials. An investor checklist includes CPI, GDP, labor, policy earnings. Futures pricing captured expectations for rate paths. Trade execution and liquidity conditions mattered for large trades. Key takeaways: inflation, yields, FX, commodities, earnings. Watch them all. Set alerts for data surprises and policy guidance. Review risk profiles as market conditions evolve. Stay informed. Markets move before you know it. Next, 3 real-world case studies with location tags. Case Study 1, USA 2022 through 2025, a story of rate paths and tech earnings. The U.S. yield dynamics and Fed language shaped global flows. Tech earnings supported indices early, then corrections followed. By 2025, guidance trends shifted toward cost control. 10-year Treasury movements remained a key market barometer. Takeaway: watch policy language, earnings, and dollar flows. Case Study 2, Europe, inflation, energy, and political risk. Energy price moves exacerbated inflation concerns in several states. Widening spreads drove fiscal sustainability questions. Rallies were tempered by energy and political concerns. Takeaway: monitor spreads, energy inputs, and election risk. Case Study 3. Asia, a mixed picture with exports and property stress. Japan benefited from a weak yen, helping exporters. China struggled with property sector stress and slower consumer spending. Policy responses varied, influencing global supply chains. Takeaway: watch export data, currency moves, and property indicators. Across regions, interconnected risks meant local events had global impact. Investors used diversification hedging and active risk monitoring. Now we connect the patterns. Analysis ahead. Analysis. The common threads are inflation versus growth, policy signals, and sentiment. Data influences policy language, which moves markets. A CPI surprise can push yields higher and trigger equity rotation. Risk management practices are essential in this environment. Portfolios may need reallocation as conditions shift. A simple framework: monitor data, adapt positions, execute tactically, use alerts, models, and liquidity considerations to stay ahead. Key takeaways: watch inflation signals, rate expectations, and corporate guidance. That sums up the market landscape. Next, a quick summary and action. Recap: volatility, central banks, earnings, and commodities remain key. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.